Know yourself first. On the trading floor, people often think they are facing the market, charts, indicators, and price movements. They believe trading is a technical game where knowledge and tools determine outcomes. The truth is, the market is not just green or red candles or complex indicators. The market is a direct reflection of the ego, where personal psychology decides the survival of your account. Carl Jung once said, "He who does not know himself is ruled by the unconscious." In trading, that unconscious shows up as biases, emotions, desires, fears, and greed, things no indicator in the world can measure. When I first started on Wall Street, I believed that if I mastered enough patterns, indicators, and historical data, I would dominate the market. I quickly realized that knowledge only helps you understand the past, but it does not help you control yourself in the present. When fear appears, when greed tempts, decisions go wrong repeatedly, over and over. This is the first lesson Jung teaches any trader who wants long-term survival. Before conquering the market, conquer yourself. Knowing yourself before knowing the market is not a cliche. It is a survival principle. In trading, the ego reveals itself clearly in entries, exits, and money management. New traders often fail to see that every decision reflects an unconscious behavioral pattern. You think you are analyzing the market, but in reality, you are analyzing your own fear and greed, subtly and thoroughly. This is where journaling becomes a crucial weapon. Writing down every decision, emotion, and reason for entering or exiting a trade helps you recognize recurring patterns you thought were random. Consider a simple example. You enter a trade when the price breaks a key resistance level. You feel exhilarated, convinced it is the perfect opportunity, but then the price reverses, and you take a big loss. Most traders blame the market, saying the breakout was fake or manipulated. A trader who understands the ego asks, "Why did I enter immediately without confirmation? Why did I feel so excited seeing the opportunity?" The answer lies in the unconscious, where greed and illusion govern behavior. Jung calls this the shadow, the hidden part of ourselves that always exists and influences actions. Trading on Wall Street is not a game of luck. It is a continuous battle with oneself. When you understand yourself, you begin to recognize common biases. FOMO, fear of missing out, the fear of missing a move that drives premature entries. Revenge trading, trying to recover losses with reckless trades, leading to double losses. Confirmation bias, only seeing data or analysis that supports your decision while ignoring warnings. Overconfidence, winning a few trades and believing the market will always obey you. These biases are not flaws. They are natural products of the human unconscious. Jung emphasized that these tendencies will persist unless you recognize and control them. A market trader is essentially holding up a mirror. The market reflects exactly what is happening in your mind. You panic, the market panics. You are greedy. The market is greedy. You are self-disciplined. The market becomes more predictable, at least for yourself. A powerful tool for working with the unconscious is self-reflection. Each night after trading, review your trades, not just the results, but your mental and emotional state. Ask yourself, how did I feel entering the trade? Fear or greed? Did I hesitate cutting losses? Did winning make me overly excited? Am I repeating mistakes from the past without realizing it? This method is not fast, but it trains the trader to increase self-awareness, reducing the unconscious impact on decisions. Once you can recognize and accept unconscious patterns, you start freeing yourself from emotional traps. Understanding the ego also means creating personal survival rules for trading. This is where classic philosophy meets Wall Street reality. Rule 1. Follow your stop loss, not because the market demands it, but because you need to control fear and ego. Rule 2. Don't trust emotions. Excitement or panic are signals from the unconscious. Rule 3. Keep an emotional and behavioral journal, so the unconscious cannot escape your observation. Successful traders are not the smartest or the most technically equipped. They are the ones who understand their own behavior, biases, and emotions. Jung noted that self-awareness is a lifelong process. In trading, this journey determines survival and long-term profitability. A real-world example. A colleague at a major hedge fund consistently won small trades, but lost big ones because he could not control fear when facing large positions. He had every analytical tool, probability model, and historical data, yet still failed, not due to lack of knowledge, but because the unconscious drove his decisions at critical moments. When he began journaling emotions, recognizing biases, and establishing personal rules, results changed, losses decreased, wins increased, and most importantly, his psychology stabilized. This is living proof of Jung's philosophy. Trading success begins with understanding yourself, not the market. Finally, knowing yourself is an ongoing process. It never ends. Every trade, every market fluctuation is a test of self-awareness. When you do not control the unconscious, you become a market victim. When you recognize, understand, and accept the unconscious, trading becomes a psychological game where correct timing, strict discipline, and high awareness are survival weapons. Wall Street mindset. The market does not care about your emotions. It reflects them. Professional traders do not chase trends or rely on luck. They know themselves to the point where the market cannot shake them. As Jung said, he who knows himself is less influenced by unconscious shadows. In trading, that is survival, the ability to endure through chaotic market cycles, and the foundation for building a sustainable trading system with a personal edge. Shadow and discipline. On Wall Street, every trader carries a hidden companion. It is invisible, silent, yet omnipresent. Jung called it the shadow, the part of ourselves we deny, suppress, or refuse to acknowledge. In trading, the shadow is not a metaphor. It is the sum of your fears, greed, impulsivity, ego, and self-deception. While novice traders believe losing is external, market manipulation, fake breakouts, or bad luck, the reality is stark. The shadow lives in every decision, quietly guiding your missteps and amplifying mistakes. The shadow is relentless. It emerges when your account swells, whispering, "You are invincible." It surfaces when you are down, screaming, "You must recover immediately." It thrives in the gaps of discipline, where rules are flexible and emotions rule. The most dangerous trades are the ones your conscious mind justifies, while the shadow orchestrates them behind the scenes. Understanding the shadow is not optional. It is survival. Without it, trading becomes a battlefield you are destined to lose. Discipline is the weapon against this unseen force. On the trading floor, discipline is not simply following rules. It is the active suppression of impulsive desires, the deliberate refusal to surrender to emotional seduction. Jung argued that awareness of the shadow allows a person to integrate it without being consumed. In trading, integration does not mean indulging greed or fear. It means recognizing its existence and enforcing uncompromising rules that counteract it. The shadow will not disappear. It will always lurk, but a disciplined trader transforms it from an enemy into a predictable variable. Consider a trader entering a position driven by excitement over a news event. The rational brain analyzes data, assesses risk, and calculates probabilities. Meanwhile, the shadow amplifies the lure, the thrill of beating the market, the subconscious desire to validate one's identity, the fear of missing an opportunity. Without discipline, the shadow wins. The trade is entered prematurely, risk is underestimated, stop losses ignored, and greed controls the exit. With discipline, the trader acknowledges the shadow, sets clear entry points, and adheres to stop-loss and risk parameters, turning what could have been impulsive self-destruction into a controlled decision. The shadow also manifests in revenge trading. A loss triggers emotional retribution, a desire to reclaim pride or erase embarrassment. The trader forgets logic and data. The shadow whispers promises of vindication. This behavior is catastrophic. On Wall Street, accounts do not recover from emotional decisions. They only compound losses. Discipline is the antidote. It is the commitment to step away, analyze, and wait for objective opportunities, no matter how loudly the shadow demands action. Professional traders do not react, they respond. The difference is subtle but decisive. Reaction is shadow-driven chaos. Response is conscious mastery. Fear is another facet of the shadow, and it is merciless. Fear disguises itself as caution, patience, or waiting for confirmation. Novice traders interpret hesitation as prudence, but unchecked fear leads to missed opportunities, shrinking positions, and self-sabotage. Jung's insight is crucial. The shadow is not just negative impulses. It is also defensive mechanisms that distort perception. Awareness transforms fear from a prison into a signal. A disciplined trader identifies fear, assesses whether it is justified, and then acts according to strategy, not emotion. Fear becomes a tool for calibration, not a trigger for paralysis. Greed is the other half of the shadow's coin. It masquerades as ambition, confidence, or taking advantage of the market. On Wall Street, greed kills accounts faster than losses themselves. Traders addicted to winning streaks, over-leveraging, or chasing pips beyond strategy limits are shadow-controlled. Discipline here means establishing clear profit targets, adhering to risk-reward ratios, and walking away when criteria are met. Greed is acknowledged, measured, and neutralized, not denied. Traders who master this are not immune to the shadow. They have institutionalized its presence into predictable, controllable behaviors. The most sophisticated traders treat the shadow as a diagnostic tool. Every irrational urge, emotional spike, or impulsive decision is an indicator of an internal imbalance. Journaling, self-assessment, and daily reflection are not optional. They are survival strategies. The shadow will exploit ignorance, fatigue, and overconfidence. Discipline converts these vulnerabilities into structured routines: pre-market analysis, defined risk parameters, scheduled review sessions, and adherence to system rules. Each element of discipline acts as a containment field, limiting the shadow's destructive potential while still allowing intuition and skill to operate. Integration of the shadow also involves acknowledging personal limitations. Overconfidence is a shadow-driven trap. It convinces traders that they can predict randomness, dominate volatility, or control outcomes that are inherently probabilistic. On Wall Street, humility is as valuable as intelligence. Discipline requires honest assessment of one's skills, risk tolerance, and psychological resilience. It demands acknowledging patterns of past failure without self-flagellation and designing strategies that compensate for human flaws. Traders who refuse this reality are doomed to repeat the same mistakes, regardless of technical knowledge. Shadow and discipline are not abstract concepts. They manifest in every aspect of market engagement: position sizing, leverage, entry timing, and exit strategy. A trader who understands the shadow will know why they double down on losing trades or why they prematurely close winners. They will know why a sure thing triggers an irresistible urge. Jung teaches that the unconscious shapes decisions silently, yet consciously recognizing it allows predictable counteraction. Discipline becomes the framework within which the shadow operates safely, ensuring that its impulses do not dictate outcomes. The interplay of shadow and discipline is also central to risk management. Every trader faces the temptation to exceed position limits, ignore stop losses, or leverage beyond comfort. The shadow whispers justification, while discipline enforces boundaries. This dynamic is not hypothetical. It defines account longevity. Traders with skill but without discipline succumb to the shadow repeatedly. Traders with discipline survive shocks, drawdowns, and unexpected volatility. Survival, in this sense, is not passive. It is active management of internal adversaries. Wall Street does not reward knowledge alone. It rewards those who manage themselves under pressure. Another critical aspect is emotional detachment. Jung emphasized that integrating the shadow requires recognition without attachment. In trading, this translates to objective analysis and rule adherence, even in the presence of extreme gains or losses. Traders who identify the shadow but cling emotionally to it still allow impulses to dominate decisions. Discipline is the mechanism that converts recognition into actionable control. It is not enough to see fear or greed. One must act in spite of them, according to predefined rules and strategy. Shadow mastery also enhances decision clarity under pressure. Markets are volatile, chaotic, and often irrational. Traders without shadow awareness freeze, overreact, or chase losses. Traders who have disciplined engagement see these moments as opportunities for execution excellence. They maintain composure, follow protocols, and let probability work in their favor. Discipline is, therefore, not just moral or ethical. It is functional. It preserves cognitive bandwidth, enforces risk management, and prevents emotional contagion from external market noise. Finally, shadow and discipline together form the bedrock of professional resilience. Markets are unpredictable, mistakes are inevitable, and volatility is constant. Knowledge, skill, and strategy provide tools, but they cannot compensate for unrecognized impulses. Discipline is the vessel, shadow is the content. Together, they shape decisions that are intentional, measured, and sustainable. Traders who master this dynamic do not chase perfection. They chase consistency, survival, and controlled risk-taking. In the world of trading, mastery of oneself is the ultimate edge, far more valuable than any chart pattern or algorithm. In summary, the shadow is the silent, invisible force that governs impulses, fear, and greed. Discipline is the conscious structure that mitigates it. Jung's philosophy is simple but brutal. Deny the shadow, and it will destroy you. Recognize it, integrate it, and survive. On Wall Street, where fortunes are made and lost in minutes, the difference between longevity and failure is often not strategy or knowledge. It is the mastery of the unseen, the disciplined navigation of one's own inner darkness. Traders who ignore this lesson do so at their peril. Those who embrace it gain not just survival, but a psychological edge that no market manipulation, volatility, or external chaos can undermine. Interaction with the collective unconscious. On the market, the individual is just a part of a larger organism. Carl Jung called this the collective unconscious, psychological patterns shared across humanity, archetypes that exist beyond time and space. On Wall Street, the collective unconscious is crowd behavior, the way millions of traders, institutional funds, and speculators respond to the same event, the same news, or the same price movement. Understanding the collective unconscious means not only understanding yourself, but also seeing how the market thinks, feels, and reacts. Retail traders often believe they are trading charts or historical data, but in reality, they are trading against and with the collective unconscious. Every price spike, every surge in volume, every panic sell or short squeeze is a physical manifestation of a shared behavioral pattern. This is why markets exhibit recurring patterns: bull traps, bear traps, panic selling, and greed-driven rallies. They are not random. They are collective reflections of human emotions and behavior. Professional traders understand that you cannot beat the crowd without understanding it. The collective unconscious can render individual decisions meaningless. A perfectly timed trade based on advanced technical analysis may fail miserably if the market is under the psychological pressure of the collective unconscious. Conversely, a trader who recognizes crowd psychology patterns can make contrarian moves intelligently, even when all indicators appear against them. Wall Street does not reward those who fail to grasp that the market is human resonance, not cold numbers. A clear example is the dot-com crash of 2000. No one could predict that the stock of a tech startup would collapse within weeks based purely on financial reports. The cause was not bad data, but the fact that the collective unconscious had amplified euphoria. Fear, greed, and mania spread from trader to trader, creating a chain reaction of irrational behavior. Those who tried to fight this emotional tide without recognizing the underlying patterns suffered heavy losses. Survivors were traders who understood crowd behavior as a signal, not noise, and built strategies to exploit it. One powerful tool for identifying the collective unconscious is market sentiment analysis, beyond charts. Surges in volume, extreme price swings without clear reason, and news capturing mass attention are all reflections of collective psychology. Professionals do not get swept up in every movement. They analyze the emotional intensity, identify the current market archetype, and make decisions based on collective behavior patterns. This is what separates amateurs from long-term survivors. Amateurs react. Professionals interact intentionally with the collective unconscious. The collective unconscious also explains irrational panics in the market. Panic selling is rarely caused by fundamentals or technicals. It arises from the archetype of fear of loss spreading through the crowd. When a few large traders start selling, fear multiplies, cascading into a psychological domino effect. Traders who understand this pattern do not sell in panic. They wait for reversal signals, set stop losses, and may even buy at extreme levels. They recognize that the collective unconscious panic is an opportunity, if observed and acted upon correctly. Another facet is greed-driven rallies. When markets surge, the fear of missing out spreads from trader to trader. The collective unconscious creates a psychological bubble where decisions are driven by emotion, not logic. A disciplined trader will pause before the bubble bursts, manage risk, and only act when reversal signs appear. This illustrates clearly that markets reflect emotional resonance more than hard data. An essential part of the collective unconscious is repeated behavioral archetypes: greed, panic, herd mentality, and speculation. These patterns exist through time, from the financial crash of 1929 to the dot-com bubble to the 2008 crash. Survivors are those who recognize these archetypes, learn to read the signals, and anticipate crowd behavior. They do not try to predict exact prices. They predict how humans will react and leverage that insight. A real-world example: the GameStop short squeeze in 2021. This was not purely a technical phenomenon. It was the collective unconscious manifesting through online communities, emotions spreading across thousands of retail traders, exerting pressure on large funds. Professionals did not blindly follow the trend. They observed collective behavior patterns, managed risk, and executed strategies to survive. Amateurs joined the frenzy and suffered massive losses when sentiment reversed. Understanding the collective unconscious also allows traders to take intelligent contrarian positions. When everyone is fearful and panic selling, it is a buying opportunity according to principle. Identify support zones, limit risk, and wait for reversal confirmation. When everyone is greedy and prices are surging, it is a time to consider profit-taking or reducing exposure. Professionals do not fight the market. They fight crowd psychology, knowing when to flow with it and when to resist. This skill determines long-term survival on Wall Street. The collective unconscious is also responsible for irrational signals and unexplained volatility. Days when the market moves sideways or explodes without clear data often reveal crowd archetypes. Inexperienced traders panic and make random trades. Professionals recognize this as an opportunity to read collective behavior patterns, position themselves probabilistically, and maintain discipline amidst chaos. In summary, the collective unconscious is not an abstract theory. It is the controlling mechanism behind market behavior. It produces recurring patterns, panic cycles, and greed-fueled surges. Survivors are those who identify these patterns, analyze crowd sentiment, and act intentionally. Those who ignore it become victims of emotional resonance. Wall Street does not reward traders who can read charts but fail to understand the crowd. Sustainable success comes from interacting consciously with the collective unconscious, turning psychological patterns into an edge and executing strategies based on human behavior, not just price movements. As Jung said, understanding the collective unconscious is understanding human nature in every market, enabling traders to remain unshaken by mass emotion and agile in any condition. Dreams, intuition, and market feel. On Wall Street, every number, every chart, every indicator is just a tool. These tools help you analyze the past and estimate probabilities, but they can never replace market intuition, that invisible yet powerful sense of the flow of money and crowd psychology. Jung once said that dreams and intuition are windows into the unconscious, and in trading, the unconscious is where the signals that the market reflects are hidden. The reality is that long-term traders do not rely solely on data. They feel the market, read invisible signals, and act before the numbers appear. Intuition is not magic. It is the result of the unconscious processing vast amounts of information, a repository of experience, observation of crowd behavior, recurring patterns, and psychological reactions. New traders often mistake intuition for random hunches. I just feel like buying now. This is useless and dangerous. Real intuition only emerges after thousands of hours observing the market, analyzing behavior, and understanding oneself. It is the product of experience integrated into the unconscious. One way to develop intuition is to study recurring market patterns. Bull traps, bear traps, short squeezes, panic selling, greed-driven rallies. These situations do not only appear on charts, they are imprinted into the trader's unconscious through experience. Over time, the unconscious recognizes signals faster than conscious reasoning. A professional trader can sense buying or selling pressure before it becomes obvious on the chart. This is why intuition is the outcome of practice and unconscious integration, not luck or random feeling. Dreams are another invaluable tool that Jung emphasized. In trading, dreams reflect hidden worries, fears, and desires, while revealing behavioral patterns the trader may not consciously recognize during the day. A trader may dream of losses, failure, or chasing opportunities. Instead of ignoring these dreams, analyzing them helps identify shadow, biases, and crowd psychology influences. This transforms the unconscious into an ally, providing insights before the trading session even begins. Market feel is the synthesized awareness of intuition, behavior observation, and data. When the market panics, market feel tells you where oversold zones and greed zones lie, and when the crowd is losing control. Amateur traders get lost in data. Professional traders read market feel and move ahead of collective action spreading through the crowd. This is not irrational. It is the result of constant connection to crowd behavior patterns, personal experience, and self-awareness, creating an invisible radar for rare opportunities. For example, when tech stocks surge, retail investors jump in with FOMO, volume spikes, and prices fluctuate with crowd sentiment. A trader with intuition and market feel senses the psychological saturation point, knows when greed has peaked, and prepares to exit or hedge positions. Traders lacking this awareness continue chasing trends, likely losing more than they gain. Wall Street does not reward technical skill alone if you ignore the invisible signals of the market. Intuition also dictates entry and exit timing. Skilled traders do not rely solely on models or indicators. They use their sense of money flow strength and crowd pressure. When FOMO escalates, intuition warns, this is an extreme point. Prepare to exit or hedge. When panic selling spreads, intuition signals a buying opportunity. These feelings originate from the unconscious but are reinforced by experience, observation, and discipline. Jung emphasized that the unconscious contains archetypes, patterns, and primordial images. In trading, these archetypes manifest in crowd behavior, opportunities, and market pressure. Intuition is how a trader decodes these invisible archetypes, recognizing signals before they appear on charts or data. Successful traders transform intuition into a strategic tool, integrated with discipline and risk management instead of acting impulsively. However, intuition fails without a foundation of discipline and self-awareness. Traders may sense the market but fail to control bias, fear, or greed, resulting in irrational decisions. Wall Street does not forgive unverified feelings. Intuition must be paired with rules, stop losses, and probabilistic calculations. Only when integrated does intuition become a sustainable competitive advantage, providing foresight and optimizing risk management. Market feel is also tied to the optimal psychological state: focused, fearless, and unemotional. In this state, intuition is at its strongest. Traders perceive money flow, crowd behavior, and extreme psychology, allowing them to act before charts reflect anything. This is the state Wall Street calls in the zone, where advantage comes not from data, but from the combination of experience, unconscious processing, and conscious awareness. Another key factor is micro-behavior and nonverbal signals. Small price movements, microstructure within candles, volume anomalies, or reactions at support resistance may not be clear on basic charts. Traders with intuition and market feel can detect subtle signals, combining experience and learned patterns to make fast, precise, and proactive decisions. This is the intersection of science and art in trading. Finally, developing intuition and market feel is not a short-term endeavor. It is a process of thousands of hours observing, journaling, self-reflecting, and learning from failures. Jung emphasized that the unconscious holds a vast repository. Intelligent traders harness this through dreams, patterns, and trained intuition. When combined with discipline, self-awareness, and risk management, intuition becomes an unmatched tool, allowing traders not only to survive, but to excel in any market condition. In conclusion, dreams, intuition, and market feel are invisible yet powerful tools that Jung teaches us to recognize. They reflect both personal and collective unconscious, revealing patterns, archetypes, and behaviors that charts alone cannot show. Successful traders know how to harness intuition, integrate it with discipline and risk management, turning invisible feeling into strategic advantage, and reading the market before most participants even realize. This is the path from awareness to survival to prosperity on Wall Street, integrating all Jungian principles into a personal trading system. By the time a trader reaches this stage, the battlefield of Wall Street is no longer just charts and numbers. It is psychology, emotion, and self-mastery. Carl Jung's principles, from shadow to the collective unconscious, from dreams to intuition, are not academic theories. They are practical tools to build a resilient, profitable trading system. The ultimate goal is not perfection in prediction. It is survival, consistency, and exploiting market behavior intelligently. A personal trading system anchored in Jungian philosophy is built in 5 pillars: self-awareness, shadow integration, disciplined rules, collective psychology analysis, and intuitive execution. Self-awareness as the foundation. Every trading system starts with understanding oneself. Without self-awareness, rules are ignored, risk is mismanaged, and shadow dominates. Jung emphasized that unconscious drives, fear, greed, ego, shape behavior unless consciously recognized. A trader must systematically journal trades, emotional states, and decision-making processes. Daily reflection is not optional. It is data for the unconscious to integrate and refine intuition. Patterns in past mistakes reveal biases, impulsive entries, revenge trades, or over-leveraged positions. Recognizing these allows a trader to design rules that preempt emotional traps. Shadow integration and risk management. Shadow is the invisible force that sabotages traders. It whispers, tempts, and deceives. Integration does not mean indulgence. It means acknowledgement. A system built on Jungian insight formalizes how shadow manifests: excessive risk-taking, impulsive trades, or overconfidence after a winning streak. By setting strict risk parameters, maximum loss per trade, position sizing limits, and stop-loss rules, shadow is constrained rather than eliminated. A trader cannot remove fear or greed from the human mind. The system must channel these forces into controlled, predictable outcomes. Shadow-aware trading is disciplined, yet adaptive. It allows intuition to operate without letting emotion dictate the account balance. Discipline as the structural framework. Discipline is the vessel through which unconscious insights become actionable strategies. A trader's system should codify entry and exit criteria, position sizing, stop-loss methodology, and profit targets, all immune to momentary emotional interference. Discipline also includes temporal management, knowing when to trade, when to step aside, and when to wait for clarity. Jungian discipline is not rigid mechanical trading, it is rule-based self-governance. Every trade adheres to the system's architecture, ensuring that impulses arising from shadow or FOMO do not compromise decision-making. On Wall Street, consistency and survival are more valuable than occasional brilliance. Collective unconscious and market analysis. Markets are not rational. They are collective expressions of human behavior. Every spike, crash, or anomalous volume surge is the unconscious of millions of participants materializing in price and sentiment. A Jungian-informed system incorporates crowd psychology analysis, sentiment indicators, macro behavioral cues, and volume price anomalies. Recognizing archetypal patterns, panic selling, greed surges, or herd mentality provides a predictive advantage. The system integrates objective market feedback into decision-making. For example, extreme fear signals buying opportunity, while euphoric rallies trigger profit-taking. Here, the system uses the collective unconscious as a guiding lens, rather than reacting blindly to price fluctuations. Intuition as the execution engine. While rules and analysis provide structure, intuition delivers timing. Intuition arises from pattern recognition embedded in the unconscious, honed by experience and constant observation. A well-designed trading system includes guidelines for interpreting market feel and subtle behavioral cues, enhancing execution decisions. Intuition does not replace rules. It optimizes them, allowing for agile responses to anomalies that static models might miss. Traders with disciplined intuition sense momentum shifts, liquidity imbalances, and psychological extremes before they manifest fully in charts. Market feel is validated against risk parameters, ensuring that gut-driven actions remain systemic, controlled, and repeatable. The 5 pillars in action. To visualize, consider a typical trading day under a Jungian system. Pre-market preparation begins with reviewing previous trades and journaling emotional insights. Self-awareness in practice. Shadow triggers, like overconfidence after a profitable streak, are noted and countered with strict position sizing, risk management in action. Entry points are evaluated against system rules, technical confirmation, risk-reward ratio, and liquidity, discipline operationalized. Market sentiment is analyzed for herd behavior patterns, collective unconscious incorporated. Finally, intuition guides timing and execution, micro-feelings validated by the system's risk framework. Every step is an integration of psychology, strategy, and observation, feedback loops, and continuous improvement. A personal trading system is not static. It evolves. Jungian feedback loops are critical: daily review of trades, reflection on emotional responses, and pattern analysis. Over time, this strengthens intuition, refines risk control, and reveals emergent archetypes in market behavior. Mistakes are mined for insight rather than punished with frustration. shadow manifestations are cataloged and mitigated. The trader learns how collective unconscious signals repeat and integrates new understanding into the system, creating a dynamic, adaptive framework that survives evolving market conditions. Journaling, the unconscious bridge. Central to this evolution is journaling. Detailed trade logs, including entry rationale, emotional state, crowd sentiment assessment, and execution observations, create a bridge between conscious strategy and unconscious insight. Patterns in these logs reveal recurring biases, intuitive hits, and misreads of market psychology. Journaling transforms experience into usable data for refining system rules and calibrating intuition, solidifying the trader's edge over both emotional volatility and the unpredictable market. Integrating risk, psychology, and execution. A Jungian system unifies risk management, psychology, and execution into a coherent, replicable process. Risk is codified: maximum exposure, stop-loss discipline, and capital allocation rules. Psychology is mapped: shadow triggers, fear, greed, and overconfidence are identified and mitigated. Execution relies on trained intuition, market feel, and behavioral observation. The system transforms trading from reactive chaos into calculated, conscious action, enabling survival through drawdowns and consistent exploitation of opportunities. Survival and edge on Wall Street. Ultimately, Wall Street rewards survival and adaptability more than raw intelligence or technical skill. A trading system grounded in Jungian principles provides both survival and edge. Shadow integration prevents catastrophic losses from emotional impulses. Self-awareness ensures continuous refinement. Discipline enforces consistency. Collective unconscious analysis reveals opportunities invisible to the untrained eye. Intuition enables timing and responsiveness. Together, these elements create a holistic system capable of thriving in uncertainty. Conclusion. The Jungian edge, integrating Jungian philosophy into a personal trading system, transforms trading from a numbers game into a mastery of human behavior, both internal and collective. Traders are no longer mere reactants to price action. They become conscious participants who leverage psychological insight, disciplined execution, and intuitive timing. Shadow, dreams, intuition, collective unconscious, and market feel are not abstract concepts. They are tools of survival and competitive advantage. On Wall Street, where uncertainty is guaranteed and chaos is constant, the ultimate edge comes from understanding the human mind in all its complexity and designing a system that turns this understanding into consistent, actionable results. The trader who internalizes these principles does not chase perfection or predict every move. They create a system resilient to their own biases, the market's unpredictability, and the emotional tides of the crowd, ensuring longevity, consistency, and profitability. This is the pinnacle of Jungian-informed trading, a personal system where psychology, strategy, and intuition converge, producing a professional edge that transcends conventional analysis. Trading is far more than numbers, charts, and indicators. It is a journey into the human mind, a discipline that merges psychology, intuition, and strategy. Carl Jung's insights, from shadow integration to the collective unconscious, from dreams to market feel, reveal that success is not about predicting the market perfectly, but about understanding yourself, understanding the crowd, and executing with discipline and awareness. Every professional trader knows that the edge comes not from luck, but from mastering the interplay between conscious rules and unconscious insight, leveraging psychology as much as technical skill. The market does not forgive ignorance of the mind. It rewards those who adapt, anticipate, and act with calculated precision. If you are ready to take your trading to the next level, Trading Mindset Lab is your source for insights, strategies, and practical guidance. Here we explore the psychological underpinnings of trading, advanced market behaviors, and techniques to sharpen your intuition and discipline. Subscribe, engage, and join a community that prioritizes mental mastery, strategic thinking, and consistent profitability. Remember, the market is not just a battlefield of numbers. It is a mirror of the human psyche. Master the mind, master the market. Subscribe to Trading Mindset Lab now and start trading smarter, not harder.